Counterparty risk and counterparty risk management. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses counterparty risk and counterparty risk management. In this video, you will understand the meaning of counterparty risk, types of transactions involving counterparty risk, importance of counterparty risk, the difference between counterparty risk and credit risk, the difference between counterparty risk and default risk, forms of counterparty risk, quantification of counterparty risk, institutions that take significant counterparty risk, how to mitigate counterparty risk, costs of reducing counterparty risk, benefits of sound counterparty risk management. Counterparty risk management, and counterparty risk management policy. Now, let us start. What is counterparty risk? Counterparty risk is the probability that the other party in an investment, credit, or trading transaction may not fulfill its part of the deal and may default on the contractual obligations. Counterpart risk is the potential loss arising from the failure of a party to a derivative contract, for example, a forward contract or swap, to fulfill its obligations towards the other party. What happens when a financial counterparty defaults on contractual duties, that is, it stops paying out what it turned to be owing to the other counterparty? In derivatives contracts, parties agree to exchange cash flows based on the price of an underlying asset. A corn farmer wishing to lock in the price he receives for his crop, for example, may sell a futures contract that will pay him more as the cost of his corn falls, locking in his financial outcome. In a derivative securities exchange, a clearinghouse acts as an intermediary, serving as the counterparty to each side of a transaction and ensuring performance if one party fails to perform on its contractual obligations. This arrangement allows investors to trade with confidence. Furthermore, in an option contract, the counterparty risk arises when the option writer refrains from buying or selling the underlying security as defined in the contract. This risk can be eliminated or reduced by the intervention of an intermediary, literally a clearinghouse, between the two counterparties, whereby it guarantees the parties' performance to each transaction, as is the case with futures contracts. For example, you have bought a corporate bond from company ABC, expecting to receive coupon payments and the bond's nominal value at maturity. Under this transaction, you are exposed to the risk that ABC cannot pay you the coupons and principal at the agreed point in time. Another example is an equity put option bought on the over-the-counter (OTC) market. If markets plunge, as they have done in recent times, the mark-to-the-market value of the put option increases sharply, introducing significant counterparty risk to the buyer of the put option. A similar risk exists in swaps, swaptions, and inflation-linked swaps. Counterparty risk is the risk of one or more parties in a financial transaction defaulting on or otherwise failing to meet their obligations on that trade. Counterparty risk is especially relevant to derivatives markets, where notional values can far exceed the size of the underlying securities. To help alleviate this risk, derivatives trades must be hedged through central counterparties, CCPs, where possible. The terms counterparty risk and counterparty credit risk are used synonymously in derivatives markets. Credit risk is a separate term that denotes the risk of a borrower defaulting on a loan. In recent years, the counterparty risks that corporates are exposed to have dramatically changed. Besides the traditional default risk that corporates hold on their customers, counterparty risk has increased regarding the exposures to financial institutions, the total supply chain, and sovereign risk. Market volatility remains high, and counterparty risk is one of the top risks to manage. Failure to manage counterparty risk effectively can result in a direct adverse cash flow effect. Types of transactions involving counterparty risk. Here are some of the common transactions that may involve counterparty risk. 1. business and trade, including receivables and payables through financial intermediaries. 2. Trade guarantees and short-term lending, including letters of credit, bankers' acceptances, unfunded commitments, and revolving credit lines. 3. Repurchase agreements and reverse repurchase agreements, as well as securities lending arrangements. And 4. Derivatives, including currency forwards, interest rate swaps, asset swaps, credit default swaps, total return swaps and options on swaps. Importance of counterparty risk. Historically, credit management at corporations has focused mainly on customer risk from new and existing customers. Traditionally, analysis done in credit departments has centered on the question, if we extend credit, or lease terms, to this customer, will they pay us back? After all, depending on the industry and type of exposure, if one of the largest customers goes bankrupt, their supplier could easily follow suit. However, a prudent corporation should consider risks coming from a broader range of counterparties beyond its customers. Traditionally, credit risk management has not been a core activity of companies outside the banking and financial services sector. The implication of not regularly managing and measuring credit risk can be substantial and potentially lead to harmful debt exposure, supply chain disruptions, reputational risk, and hefty legal fees incurred enforcing customer contracts. The global financial crisis has reinforced the importance of adequate risk management, including dealing with exposure to counterparties. The most important lesson from the crisis is that most investors in the affected markets experienced minimal downside, provided they had proper counterparty risk management practices in place. Counterparty risk is widely present in financial markets and is a risk experienced by all investors, both large and small. For example, all investors in bonds, or any other type of loan, take on a certain amount of counterparty risk, significantly when investing in corporate bonds. Most fixed-income investors are aware of this and are making an informed decision to take on this additional credit risk in return for higher yields. Large institutional investors understand the importance of managing counterparty risk effectively. Large investors often use equity put options, swaps, swaptions and inflation-linked swaps to hedge their market risk. Almost all these transactions are executed in the over-the-counter, OTC, market simply because the listed market does not offer them the right type of hedging instruments. In the OTC market, investment banks are taking on the other side of the transaction. Hence, by nature, most large institutional investors must cope with a great deal of counterparty risk. As the fall of Lehman Brothers has illustrated, perceived protection will be worthless in case of a default of the hedge provider, unless you are prepared and know how to deal with counterparty risk. Two important factors have resulted in greater attention to counterparty risk related to financial institutions in the Treasury. Firstly, financial institutions are not immune to default. Secondly, the larger and better-rated corporates are now hoarding a day's more cash compared to their pre-2008 crisis practice due to limited investment opportunities in the current economic environment, limited debt redemption and share buyback possibilities and the desire to have financial flexibility. Several trends can be identified regarding counterparty risk in the corporate landscape. In a corporate-to-bank relationship, counterparty risk is being increasingly assessed bilaterally. For example, the days are over when counterparty risk mitigating arrangements, such as the Credit Support Annex, CSA, of an International Swaps and Derivative Association, ISDA, agreement, were only in favor of financial institutions. Nowadays, CSAs are more based on the equivalence between corporate and financial institutions. Difference between counterparty risk and credit risk. Counterparty risk is a subset of credit risk. Counterparty risk is a form of credit risk. Credit risks typically refers to the risk you assume when the counterparty cannot pay back a loan, for example, when you buy bonds. Counterparty risk is the risk that one or more parties in a financial transaction will fail to fulfill their side of the contractual agreement. It may arise either because of the counterparty's unwillingness to observe the contractual obligations or because of a default, possibly occasioned by poor financial health. Credit risk is incurring losses because a counterparty in a derivative transaction has defaulted, i.e., is no more able to fulfill obligations associated with the derivative contract, partially or wholly. It may arise from the inability or unwillingness of the party to meet such obligations or from any other reason. An example is the credit risk associated with over-the-counter, OTC, derivatives. Credit risk is also referred to as default risk. However, credit risk is broader in scope and includes other forms, subclasses, of risks such as counterparty risk and deteriorating credit quality. Counterparty risk generally emerges in two main types of financial contracts: 1. OTC derivatives such as interest rate swaps and swaptions, and 2. Securities financial transactions where securities are used to borrow cash or vice versa. Credit risk is that a borrower will fail to pay the principal, interest, or some of it due to insolvency. As a result, the creditor may suffer cash flow disruptions and increased collection or recovery costs. There are 5 significant differences between counterparty risk and credit risk. First, counterparty risk arises from the inability or failure to make a payment, but the amount of exposure is not predetermined. Credit risk is the possibility of loss on account of default due to the inability or unwillingness to meet its liability. In this case, the amount of loss is predetermined. Second, counterparty risk is most relevant in derivatives markets and especially OTC trades, while credit risk finds its relevance in loans and advances given by banks and financial institutions. A derivatives market is a financial marketplace where traded derivatives, including futures and options, consist of financial instruments used for hedging purposes or speculation by individual and institutional investors. Third, counterparty risk is a subset of credit risk. Credit risk includes counterparty risk. Credit risk refers to the probability of a loss owing to the borrower's failure to repay the loan or meet debt obligations. In other words, it relates to the possibility that the lender or creditor may not receive the debt's principal and an interest component, resulting in interrupted cash flow and increased cost of collection. Fourth, counterparty risk exposures vary based on the mark-to-market, MTM, position on the default date. While credit risk exposure is mainly predetermined and does not vary. This implies that the notional amount at risk in respect of credit risk is known at any time during the life of the contract with some degree of certainty. When buying a bond, for example, the notional amount at risk is close to par. Variables such as a floating rate of interest cause uncertainty of the amount owed. For counterparty risk, the value of the contract in the future is uncertain. The mark-to-market, MTM, value of a derivative at any date is the net of all future cash flows that are highly uncertain. What is a mark-to-market, MTM? Mark-to-market is the present value of all the payments that a party expects to receive, less those it is obliged to make. These payments may be scheduled to occur over a long period and show a strong dependence on market variables. As such, the current mark-to-market does not constitute an immediate liability by one party to the other. Mark-to-market can be positive or negative depending on the magnitude of all future payments and current market rates. Lastly, counterparty risk is bilateral because each party in a derivative transaction risks the other. The contract value of counterparty risk can be positive or negative. In the case of credit risk, only one party, the creditor, has lending risk. The implication is that there is an overlapping between counterparty and credit risks, but credit risk is wider than counterparty risk. Hence, the term counterparty credit risk is relevant. It is also referred to simply as counterparty risk. Counterparty credit risk is the risk that a counterparty to a derivative contract may be unable or unwilling to fulfill contractual obligations concerning making timely payments and settling due payables. This situation may arise from an actual default or by deterioration in a counterparty's credit quality. In the event of default, immediate losses would be incurred by the other counterparty. In contrast, Future losses, in the event of deteriorating credit quality, would be expected, with an actual impact being inflicted on mark-to-market valuations. Difference between counterparty risk and default risk. Counterparty risk is the potential loss that results from a counterparty to a derivative contract, specifically a forward contract or swap, unfulfilling its obligations towards the other party. What happens when a financial counterparty defaults on contractual obligations? That is, it stops paying out what it turned to be owing to the other counterparty. For example, in an option contract, the counterparty risk arises when the option writer refrains from buying or selling the underlying security as defined in the contract. On the other hand, default risk is the probability that a party to a derivative contract, for example, a swap or derivative or structured instrument, will not be able to meet its respective obligations, either partially, fully, or timely. This involves a situation where interest and principal payments or swap payments is repaid as agreed. The default risk is also known as a credit risk. However, in specific contexts, default risk is treated as part or subcategory of the credit risk. Counterparty is the risk of loss that arises from a counterparty's failure to perform. Contrary to default risk, which is due to a failure to repay a credit obligation, counterparty risk comes into play from a failure to honor commitments on a contract, as in the case of an in-the-money swap or option position. The awareness of counterparty risk and risk has increased significantly. Counterparty risk has always been present, but it simply did not emerge on the public's radar until now. The current ubiquitous awareness of counterparty risk is illustrated by dramatically increased credit spreads, downward adjustments of credit ratings, and the increased number of bankruptcies and takeovers in the financial industry. This has led to a decrease in the number of counterparties that are able and willing to take on the risk of institutional investors, and an increase in the probability that these parties will eventually default on their obligations. Forms of counterparty risk. There are two forms of counterparty risk: pre-settlement risk and settlement risk. Pre-settlement risk. Pre-settlement risk is the risk that a counterparty will default before the contract's expiration date, that is, before the final settlement of the transaction. Settlement risk. Settlement risk is the risk of counterparty risk during the settlement process. It arises because the parties to a transaction, such as a forward contract, do not execute or perform on their obligations simultaneously. For example, there may be a delay in delivering collateral or the instrument underlying the contract. Quantification of counterparty risk. Methods used to mitigate or manage risks are not 100% effective. They cannot eradicate the risk. Therefore, it is crucial for an institution to correctly quantify the remaining counterparty risk and ensure that compensation is commensurate with the level of risk. Generally, there are three levels at which counterparty risk can be quantified. 1. Trade level, where all the characteristics of the trade and associated risk factors are considered. 2. Counterparty level, where risk mitigants such as netting and collateralization are considered for each party, and 3. Portfolio level, where overall counterparty risk is considered while at the same time recognizing that only a small percentage of the counterparties will default. Institutions that take significant counterparty risk. Institutions that take significant counterparty risk can be categorized into three classes. 1. Large derivatives players. These are typically large banks that have high numbers of derivatives on their books. They often trade with each other but also have many clients from different sectors within the financial industry. These banks participate in almost every derivative product present on the market, including interest rate swaps, foreign exchange forwards, and credit derivatives. Players in this category almost always post collateral against their positions. 2. Medium derivatives players. These are typically smaller banks, hedge funds, and pension funds. Players in this category trade with a relatively large number of clients. They are active in a large derivatives market. Also, they may not always post collateral against positions. 3. Small derivatives players. These can be small financial institutions, large corporates, or sovereign entities with significant derivatives requirements. For example, they may be looking to hedge their investments. They have just a few derivatives trades on their books and have a relatively small number of counterparties. They may also specialize in a specific asset class, say, foreign exchange products, and often do not post collateral. Large derivatives players have the highest credit quality. Before the 2007-2008 financial crisis, their credit spreads amounted to just a few basis points per annum. However, small players such as insurance firms and pension plans have demonstrated strong credit quality over the years and even managed to bargain for favorable trade terms such as one-way collateral agreements. The credit quality of large players should never be ignored. Events over the last couple of years have only reinforced the idea that the bilateral nature of risk is ever present. How to mitigate counterparty risk? It is worthwhile to see how large institutional investors and banks cope with counterparty risk to address this question. Banks are active players in the over-the-counter, OTC, market, hence banks are exposed to counterparty risk. Hedging counterparty risk is, in fact, relatively easy to achieve, and OTC market participants have been very successful at it. Over-the-counters, OTCs, are bespoke contracts traded off exchange with specific conditions determined and agreed by the buyer and seller, counterparties. On the flip side, OTC derivatives are more illiquid as they are traded out of clearinghouses or exchanges, exposing the transactions to increased credit default risk. Examples of OTC are interest rate derivative, credit derivative, commodity derivative, equity derivative, forward contracts, and swaps. What are the strategies adopted by the banks to mitigate counterparty risks? Banks usually adopt the following strategies to mitigate counterparty risks. 1. Hedging. Hedging is the risk management strategy the banks adopt in investing to eliminate or reduce the risk of adverse price movements in financial instruments, bonds, notes, and shares, foreign exchange derivatives or precious metals. Generally, investors can hedge the price in the international commodity exchange/markets, using hedging products such as futures and options as permitted by RBI from time to time. 2. Trading with selected counterparties. Banks trade only with counterparties with excellent credit quality under this strategy. In this way, the risk is mitigated as their default is highly improbable despite potentially huge exposure. One of the most effective ways to reduce counterparty risk is to trade only with high-quality counterparties with high credit ratings, such as AAA. This will ensure better credit risk management and decreasing the chances of future losses. However, counterparty transactions cannot entirely rely on the above strategy. The concept of too big to fail in respect of counterparty risks, which was prevailing in international banking, turned out to be an illusion after the big collapse of Lehman Brothers, Icelandic banks, Monolin Insurance Company, Fannie Mae and Freddie Mac, even though all these companies had AAA status. 3. Clothes out netting. Netting is another valuable tool to reduce this risk. Clothes out netting is a standard risk mitigation method for counterparty risk practiced worldwide. Under this method, netting allows amounts owed to a counterparty to offset those owed by the other counterparty. However, it is possible only in cases of bidirectional transactions between counterparties, which rarely happen. Usually, there are multiple trades undertaken by the financial between them, such as between two counterparties. There may be various, some will have a positive value, MTM gain, and some will have a negative value, MTM loss. The loss can be reduced significantly by netting such positions, and counterparty risk can be reduced substantially. 4. Collateralized transactions. Collateralization is another way to reduce credit exposure is using eligible financial collateral for the transactions. Collateralization involves placing high-quality collateral such as cash or liquid securities, reducing net exposure. Only cash, deposit, liq surrender value and gold are accepted as eligible collateral security. 5. Pro-rate sharing of security. In the case of a consortium, multiple banking and other bank syndicating agents agreed on a security clause to be incorporated into the joint agreement. This would help a bank to share the risk amongst the other member banks. A letter in this regard will be obtained from the leader bank. 6. Guarantees as credit protection. Taking suitable personal as a corporate guarantee is another way to mitigate the risk. 7. Capital conservation buffer. The Capital Conservation Buffer, CCB, is planned to safeguard those banks that ought to build up capital buffers during regular times, which can be utilized during the stressed periods to wipe out the losses incurred. Basel III norms recommend that conservative capital buffer in the form of common equity. 8. Diversification is another handy tool to reduce, if not necessarily eliminate, the risk. By trading with multiple counterparties, there will not be a single counterparty with significant exposure, facilitating a single counterparty. 9. Shifting from bilateral trades to centralized trades. All transactions are undertaken with a centralized counterparty, such as exchanges and clearinghouses, which eliminate the specific risk but give rise to systematic risk. Costs of reducing counterparty risk. There are no direct monetary costs involved other than drafting documentation and potential external legal advice. However, the drafting of CSA should be negotiated by the two parties. Not anything goes, and every clause has its value to each party involved. For most investors, seeking external legal support when drafting documentation seems therefore sensible. Also, the advice is often sought for the real economic and monetary consequences of what is drafted in the documentation. In addition, having experienced and sound collateral management operations in place is a necessity. Given the potentially disastrous consequences of not addressing counterparty risk appropriately, drafting documentation and subsequent collateral management costs are negligible. Benefits of sound counterparty risk management. If a company rigorously follows best practices in credit and counterparty risk management, it can achieve certain advantages, including 1. Unifying the credit assessment practice by implementing repeatable processes and standardizing outputs. 2. Qualifying new customers quickly, reducing response time, and improving customer satisfaction. 3. Developing a more balanced portfolio of counterparties to withstand any downturns. 4. Receiving early warning signals necessary for proactive exposure management. 5. Minimizing costs in both lousy debt expense and legal expenses incurred to enforce contracts. And 6. Protecting your company's assets that are on lease or credit terms to customers. Counterparty risk management. Treasurers should avoid this becoming an administrative process. Instead, it should be a risk management process. It will be important that counterparty risk can be monitored and reported continuously. Having real-time access to exposure and market data will be a prerequisite to recalculate the exposures frequently. Market volatility can change exposure values rapidly. A credit default swap protects against default. In the event of a default, the buyer will receive compensation. The spread, credit default swap's spread, is the insurance premium paid for the swap. There are 5 major steps involved in protecting a firm from counterparty loss. 1. Evaluate potential counterparty. 2. Perform peer analysis. 3. Determine a credit score. 4. Set credit limits and terms. And 5. Monitor exposures. Now, let us discuss these 5 steps involved in protecting a firm from counterparty risk. 1. Evaluate potential counterparty. A good starting point for monitoring the financial stability has traditionally been to assess the credit rating of the institutions as published by rating agencies. However, recent history has proved that such ratings lag somewhat behind other indicators and that they do not move quickly enough in periods of significant market volatility. Since the credit rating is perceived to be slightly more reactive, it will have to be treated carefully. Market-driven indicators, such as credit default swap, CDS, spreads, are more sensitive to market changes. Any changes in the perceived creditworthiness are instantly reflected in the CD's pricing. Tracking CD's spreads on financial institutions can give a good proxy of their credit standing. However, how to use credit default swaps, CDS, spreads effectively and incorporate them into a counterparty risk management policy is sometimes still unclear. Setting fixed limits on CD's values is not flexible enough when the market changes as a whole. Instead, a more dynamic approach based on the relative standing of a financial institution in the form of a ranking compared to its peers will add more value, or the trend in the CDs of a FI compared against that of its peers can give a good indication. A combination of the credit rating and normalized credit default swaps, CDS, spreads will give a proxy of the financial institution's financial stability and the probability of default. It is a good practice to evaluate the financial strength of a new counterparty before entering a business relationship. This information should be captured, documented, and archived in accordance with a company's credit policies across geographies and departments, using standardized data entry templates that can be easily accessed and implemented across the company. However, financial data from suppliers, customers, distributors, or banking counterparties is often not captured in different formats by analysts across the company, making comprehensive analyses and credit risk reporting difficult. To address gaps in data on counterparties, a third-party vendor can be employed to provide financial statements on firms where the company is missing data. Storing and gathering financial data is critical when evaluating the financial statements of a given counterparty. Necessary ratios can be calculated for a given business, but liquidity and solvency measures are the most important for managing credit risk. For example, the current ratio, current assets and current liabilities, measures a company's ability to cover its short-term obligations with existing assets on hand. Liquidity analysis aims to determine whether the company has enough liquidity to meet its short-term obligations. Solvency analysis seeks to establish whether the company is financially healthy to recover from a loss or a period of losses. A typical technique to analyze insolvency risk is to focus on the leverage ratio, which compares a company's total debt to its total equity amount. 2. Perform peer analysis. Peer analysis allows corporations to make more informed decisions by comparing credit risk information and financial ratios for a specific customer, distributor, or supplier against a group of their peers. Peer groups should be defined by industry, region, or company size. After a peer is selected and financial information is provided, an analysis should outline credit risk trends for the company and its peers. Since accumulating peer credit risk and data can take years and tremendous effort, using a third-party database with already available financial information can save valuable time. The magnitude of counterparty risk can be estimated according to the expected loss, L, which is a combination of the following elements. 1. Probability of default, PD, the probability that the counterparty will default. Besides the actual exposure, potential future exposure can also be considered. 2. Exposure at default, EAD, the total amount of exposure on the counterparty at default. This is the maximum exposure expected to occur in the future at a certain confidence level, based on a credit at-risk model. And 3. Loss given default, LGD, magnitude of actual loss on the exposure at default. This methodology is also typically applied by financial institutions to assess counterparty risk and associated expected loss. The probability of default is an indicator of the credit standing of the counterparty, whereas the latter two are an indicator of the actual size of the exposure. The maximum exposure limits should be defined in the counterparty risk management policy. Another form of counterparty risk is settlement risk, O. The risk that one party of the agreement does not deliver security, or its value in cash, as per the agreement after the other party has already provided the security or cash value. Whereas ARD and LGD are calculated on the net market value for derivatives, settlement risk entails risk to the entire face value of the exposure. For example, settlement risk can be mitigated by the joining multi-currency cash settlement system continuous link settlement, CLS, which settles gross transactions of both legs of trades simultaneously with immediate finality. 3. Determine credit score. Implementing a quantitative probability of default, PD, credit measure results in the most accurate credit risk assessments to derive a score or other metric from measuring creditworthiness. This metric should then be mapped to an internal credit score. We recommend implementing internal credit scorecards that incorporate quantitative and qualitative factors. Suppose corporations choose to develop their predictive scoring models. In that case, it is imperative to use validated third-party models as input to their model or as benchmarks to ensure accuracy. Corporations should also go one step further and ensure that the same scoring system and framework are being used across divisions and geographies to ensure consistency across the entire organization. 4. Set credit limits and terms. Companies can have hundreds, if not thousands, of exposures in the form of credit extended to customers and distributors. These exposures must be consolidated and monitored when the direction is originated, for example, when a new customer signs a financing agreement, or a new contract is signed with a supplier. Like a commercial bank, a corporation must manage its entire portfolio of loans. Each further exposure should be compared against predefined limits for counterparties, industry sectors, countries, or product types before making a risk decision. In addition to dynamic financial analysis, a prudent credit manager also examines qualitative factors, such as its competitive positioning, history, and market reputation. Implementing a limits monitoring system sends alerts when limits are breached, particularly when extending more credit to a watchlist customer or distributor beyond the predefined limit. 5. Monitor exposures. For a comprehensive and more relevant view of risk across an organization, it is best to consolidate exposures worldwide, across subsidiaries and business units, using limits management software tied to the credit analysis and origination system. Implementing a company-wide monitoring system enables a company's risk management function to push boundaries and review policies down to the business unit level. Having such a system in place allows a company to manage credit risk exposures actively. Early identification of potential defaults allows a credit manager to act to avoid disastrous situations. Effective credit management also means being prepared for adverse outcomes. Good credit managers should do regular and rigorous scenario analysis on their credit exposures and include both macro and industry-specific shocks in the exercise. The key to effective stress testing is creating appropriate scenarios and ensuring the underlying analytics are meaningful. Using a third-party tool that adjusts default probabilities based on public equity prices gives you a forward-looking indicator for your analysis. Counterparty risk management policy. It is essential to implement a clear policy to manage and monitor counterparty risk, and it should, at the very least, address the following items. 1. Eligible counterparties for treasury transactions, plus acceptance criteria for new counterparties, for example, to ensure consistent contract and credit support agreements. This will also be linked to credit commitment. Banks that provide credit support to the company will probably also demand ancillary business, so there should be a balanced relationship. While the pre-crisis trend was to rationalize the number of bank relationships, since 2008, it has moved to one of diversification. This is a trade-off between cost optimization and risk mitigation that corporates should make. 2. Eligible instruments and transactions, which can be credit standing dependent. 3. Term and duration of transactions, which can be credit standing dependent. 4. Variable maximum credit exposure limits based on credit standing. 5. Exposure measurement. This focuses on how to identify and quantify counterparty risk. 6. Responsibility and accountability. This is necessary to establish what level and who should have ultimate responsibility for managing the counterparty risk. 7. Decision-making. To provide an overall framework for staff decision-making, including treatment of breaches. 8. Key performance indicators, KPIs. This is necessary to ensure effective selection of KPIs to measure and monitor performance. 9. Reporting. This helps to develop reporting requirements and format. 10. Continuous improvement, to determine what procedures are required to keep the policy up to date. Conclusion. Counterparty risk and counterparty risk management have been discussed in this video. Counterparty risk is the probability that the other party in an investment, credit, or trading transaction may not fulfill its part of the deal and may default on the contractual obligations. Implementing robust credit risk frameworks and processes is not an option for corporations because it is imperative to build a solid and sustainable business. Depending on the corporation's size, the credit and counterparty risk management process can be sophisticated. However, all firms must take the basic steps of standardizing how financial data is collected and analyzed, implementing credit limits, introducing monitoring capabilities, and implementing workflows and corporate credit policies. With sound credit practices, a company receives early warning signals on bad credits, improves customer service and, above all, makes better decisions to keep the business running smoothly. As such, corporations' credit and counterparty risk management process should be viewed as a high strategic priority. If properly addressed and with good processes in place, counterparty risk can easily be reduced to a low level, even in extreme market circumstances, when the market risk reduction provided by these instruments has proven very effective to many pension funds. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial to you, then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.